This week at the zoo, the Nasdaq index continued to rocket as the Dow and S&P 500 lagged behind. Hello and welcome back to the Wall Street Petting Zoo. This is our This Week at the Zoo segment in which we review the week's news and look ahead to the coming week. I'm Christopher Smith.
And I'm Robert Coburn. And this week, we're going to try a slightly different format. Instead of working our way chronologically through the week and trying to cover every relevant news item, we're going to organize the discussion thematically. We'd love to hear your listener feedback on what you like or don't like about the new format.
Yeah, so our first big theme of the week is about China. China stocks rocketed higher this week after Chinese state media assured investors that China has shaken off the effects of the pandemic, and they called on investors to pour money into China's stock markets as the country heads into a period of great prosperity. One China ETF that I watched gained about 15% by Thursday, but then it lost about half of that gain at the end of the week after rumors circulated that China's Social Security Fund was taking advantage of the high prices to sell off hundreds of millions of shares in a state owned insurance company. So there you go. That's a centrally planned economy for you.
And our second story of the week is that economic data have continued to surpass analyst expectations in a big way. Citigroup produces this index called the Economic Surprise Index that measures just how much economic data are beating or missing analyst expectations. Right now, that index has soared to nearly twice its highest level of the last 20 years. That means that analyst forecasts on the economy have been way more negative than we're actually seeing in the data. This week, we got positive surprises on job openings and jobless claims, so the labor market is stronger than expected. We got a big positive surprise on mortgage applications, so the real estate market is also stronger than expected. And we got big positive surprises on several different indexes of the services sector, which suggests leisure and restaurant businesses are stronger than expected. Overall, the data from May and June are looking really good, but having said that, it's possible that the data for July may be less good. The surge in coronavirus cases has a lot of businesses reclosing, and we're seeing a second wave of retail and energy companies going bankrupt. So we want to be cautious going forward from here.
Yeah, and then finally, our last big story of the week is that the Federal Reserve reduced its balance sheet for the fourth consecutive week this week. This is important because the rally in stocks has been mostly driven by the Fed injecting money into the stock market. Asset prices have gotten a little bit inflated because of all this money flowing out there. If the Fed is now removing money, then we could see some deflation of those prices. We could see the stock market rally fizzle a little bit. However, the drawdown of $250 billion in the last 4 weeks has been pretty small compared to the $7 trillion that are still on the balance sheet. Also, when you break down why the number has been coming down, it's basically because the Fed has been shutting down some of its short term emergency lending programs, specifically the repo program has essentially gone to zero. And it's also got some swaps open with foreign central banks, which have come down by about half. We will see about another $190 billion reduction as these programs fully wind down in the coming weeks. And then the balance sheet should stabilize or even increase from there. So we've got most of the drawdown that we're going to get already, but we still do have another $190 billion to come off the balance sheets. I don't think this is a huge risk because, as I said, $190 billion is relatively small in the scope of that $7 trillion. But the US dollar might beat stocks and metals for the next couple of weeks. We might see a little bit of strengthening in the dollar, a little bit of weakening in stocks and metals as the Fed continues to wind those programs down.
And last week, we didn't alert any stocks because we took a bye week from the podcast for the 4th of July. So let's look ahead of the coming week. Next week, we kick off earnings season. We've got 100 companies reporting results next week, including most of the big banks. Chris, what are you watching next week?
Well, I really like the semiconductor sector this season, and we got several early results from semiconductor companies. They were pretty much all blowouts. And the thing that I really liked about the early semiconductor earnings was that a lot of companies in this economy have been hesitant to issue any kind of guidance for what to expect in the future. But the semiconductor companies are an exception to that. They have been issuing guidance, and their forecasts have been really optimistic so far. So we do have one semiconductor company reporting this week. It's Taiwan Semiconductor that reports on Thursday. And I'm really excited to see the results from this company. It has been a really, really strong company for the last several years, has tended to beat analyst estimates a lot. So I feel optimistic about that one, and I've got a couple option calls on Taiwan Semiconductor, so we'll see what happens with their earnings. I'm also going to be pretty closely watching the earnings from banks. I bought a couple of cheap call options on a banking ETF because a lot of the big banks like Bank of America and JP Morgan and Citigroup are expected to beat analyst estimates this week. So I think that we might see a bit of a surge in the banking ETF and some more talk about people rotating out of tech and into some undervalued sectors like banks. What are you
Chris,
watching, Robert?
yeah, Chris, as a Bank of America shareholder, I sure hope they beat estimates. This week, though, with COVID cases on the rise again, I'm continuing to watch gaming stocks like Zynga, which finally broke above $10 a share for the first time ever this week. Activision Blizzard, which finally broke above $80 this week, which they only saw a brief glimpse of back in September of 2018 before the stock crashed. Tencent, which has been on a tear since March, and Take-Two Interactive, which that has been reaching new highs since the middle of June. PC demand has risen to levels that haven't been seen since 2009, and according to John Petty Research, millions of people are upgrading their computers at home with gaming hardware such as graphics cards, high refresh rate monitors, and steering wheels. I guess that some people miss their hour-long commutes so much that they want to get behind the wheel virtually. Even with the return of all the major sports and a return to what most refer to as relative normality, many analysts are expecting the gaming industry to continue this upward trend.
Well, that bodes well for my semiconductor play too, Robert, because if folks are upgrading their PCs, then I should see a little bit of benefit to some of my semiconductor stocks and even maybe some HP, Dell, some of the PC makers will see a bump as well.
Yeah, that was surprising to me that the PC demand has raised up to levels they haven't seen since 2009 because of the last like 10, 12 years all you've heard about home computers is that they're going out.
Yeah, I think it was JP Morgan or Goldman Sachs, one of the big investment banks recently downgraded Intel and Dell and HP because they said that PC demand was likely to weaken in the back half of the year. But I did see that the CEO of Dell just bought a bunch of Dell stock, so he's obviously feeling optimistic about the company. All right, folks. Well, if you heard anything on the podcast that you found helpful to you, please give us a like, share, or comment. We'd also love to hear from you about how you liked the new format for dealing with the news. We're trying to make it a little bit more digestible for you. So if we succeeded, please leave a comment and let us know. And if you like the old format better, we'd love to hear that from you too. You can also follow us on Twitter. You can like us on Facebook and get regular updates about news throughout the week and get our videos to you as soon as we post them. And if you prefer an audio version of the podcast, you can follow us on Podbean or on iTunes if you are an iPhone user. Uh, we don't do any advertising for the podcast, so if you could let your friends know about it, that would help us a great deal, get the word out. And if you'd like to support the podcast in a financial way, we also have a referral link for Webull underneath our YouTube video. If you click that, open up a Webull account and deposit $100, you'll get a couple free stocks, and we also will get a couple free stocks, and that will help support the podcast. Thanks so much for listening, and we'll see you back at the zoo next week.
See ya.